I enjoy this summit so much because I get to sort of stretch my own abilities, my own mind into areas that I don't know too much about. Fortunately, Louise throws me a bone every now and then, and I actually get to moderate a panel that I might have some area of a little bit of understanding about, and this would be it. It's we want to talk about investing globally. Now, the fact is there's good and bad to everything. The good is I kind of know this topic. The bad is I don't know it anywhere as well as the two guys on my right and left, but that's good for you because these two gentlemen really understand the world from an investing perspective, and in this day and age, probably always, that means understanding the world from a socio-political and socioeconomic perspective as well. And it's frankly a very exciting world. The one thing that attracts me to business and investing is that it often allows you a lens on the world that is not sometimes as negative as the news will portray it. Sure, the bad comes through in economics, and the good comes through in looking at business around the world, but it is a world that you look through a lens of opportunity. So I want to discuss where those opportunities are, where those pitfalls are, and where the trends are that we may not be seeing. Sometimes by the time I'm reporting on them, they're already there, they're already baked in, but there are things going on, and these two gentlemen will know about them, that we need to take into consideration. So I'm going to start by asking my two panelists to give us their overview, their sort of economic overview on the world, and obviously that there isn't a one-to-one correlation between whether you think Europe's going to do better and whether you should invest in it. China is a perfect example of that. China's been doing very, very well, but for the average investor, it has not returned anything that looks like its economic growth in the last few years. So, the fact that something's going to do well doesn't necessarily mean it's where your money should be. On my right, your left, is Stephen Toy with Wilbur Ross and Company. As you know, Wilbur wasn't able to join us, but Stephen heads up your investment committee, do you not?
I chair the investment committee.
He chairs the investment committee, so he knows all this stuff. Wilbur would have been asking him for some speaking notes today. And on my left, your right, is John Allen. He's the chairman and CEO of the Greater China Corporation. John, let me start with you, your sort of overview of where things are going.
Thank you, Ali. But first of all, I'd like to thank three people. Four people. I'd like to thank Matthew and Louise for the opportunity, because this conference to me represents not where we've been or where we are, but where we're going. I think that's our focus, and that's very exciting. The other two people I'd like to thank is Turkey Faisal, Prince Faisal, because there's a picture of him, and I have a lot of funny pictures of him. And one of my closest friends and advisors was his classmate at Lawrenceville, and they just celebrated their 50th anniversary. And I had a really good joke to tell about Turkey Faisal. So he's here in spirit, and I'm sorry he's not with us. The other person I have to thank is Wilbur Ross, because Wilbur and I were both at Yale and then Harvard Business School, but he was like a rocket. He was a Baker Scholar at Harvard. That's a top creme de la creme. In a race to see who could get to be a billionaire first, he was across that finish line so fast, and I was way back there someplace. So anyway, he is so brilliant that it gives us another chance here. Now, in terms of the answer to your question, I'll start with China because, I'm identified with China, but then I'll go to the world. In China, look for four things. First of all, don't sell China short. We like to criticize China in the West. We complain about their foreign exchange and everything about them. But China, in fact, just opened up regulations to allow more short selling of their securities. And they also opened the door for more hedge funds, 287 compared to 87. Short selling, 2/3 of the stocks now can be sold short. This is helping up this gradual liberalization. So don't sell them short. But what you are going to see is you're going to see a massive conversion of their debt to equity. Everybody looks at the China Investment Corporation, and that's their sovereign wealth fund. And they say, oh, they've got $350 billion there, and boy, they're beginning to invest it around the world, and even though a lot of it is in Treasury. What they don't look at is this giant elephant behind that, which is the State Agency of Foreign Exchange, SAFE. SAFE has $3.5 $4 trillion. Trillion dollars. And that is about half in debt, and of that debt, about half of it is in U.S. Treasuries, but the rest is beginning to migrate into equity. So one of the things that's happening right now, most of the scholars, and I'd be interested in hearing your opinion, are saying that China will gradually open the door to liberalization of currency controls, and that the renminbi will be freely convertible within the next 5 years. I think it might even accelerate that. So as you see this happening, though, there's a phenomenon, and I meant to bring a balloon with me, but I couldn't find one. And what I do is I blow up the balloon, and then I tie a string around it. And I say the size of the balloon is global capital markets, and the little thing, it not only expands and contracts, mostly expands, but also it goes from debt to equity, debt, equity. And what you're going to see from China is a massive change from debt to equity. And as that happens, think of the impact that may have on, on U.S. Treasury rates, for example, as they begin to diversify into equities from debt. It's a major factor that I think a lot of economists are not looking at. And then the final thing I'll say about China is people are always saying, hey, John, what shall I invest in China? How do I invest in China? I say, listen, just read their 5-year plan, because the 5-year plan delineates the areas of focus, and those areas of focus get all of the government support, the financial support. So just, and the other funny thing about China is, here in the West, like building the 2nd Avenue subway, how many decades has that taken? But in China you say, oh, they've just completed the world's longest bridge. They've just completed the world's highest railroad. They've just completed, the 2nd phase of the fastest trains. It's not we are planning this, but we've done this. So but China in my mind is a very benign partner. It's the soft power, and I think that we can embrace China as we should every other country in the world and move ahead. So I'll stop there.
All right, then we'll move on to other areas.
And then I'll go to the global picture.
Okay, very good. Stephen, why don't we start with China then on your side?
Sure. And first, I'll describe my organization, just give you a perspective of where I'll be coming from. So we're a private equity fund. We've got a global mandate and offices here in New York, Mumbai, Tokyo, and Beijing. So we do view the world and the world economies as interrelated. Vis-a-vis China, we agree with John. We believe it's an economy that's opening up. It's an economy that's done very well over the past recent years. I'd say in the near term, we're a little bit more cautious in the near term, but we think the long-term fundamentals are there. And why are we cautious? The recent data has been very good, but the reason it's been very good is they've reverted back to what they were doing in the past, which is really government spending to stimulate the economy. I think they've had they've got a big challenge ahead of them to convert the economy into a consumption-driven economy versus a spending-driven economy or a government spend economy. And I think we're going to see that in the numbers. In the past several months, while the growth figures have been very strong, it's again been led by infrastructure and projects of the like. At some point, they are going to want to push forward and get the consumers to spend more. And that transition, we think, is going to be difficult. And it's going to be difficult to sustain the rates of growth that they had. So, we're not sure they can convert to a consumption-driven economy and continue to have 8, 9, 10% growth per year. We do think it's sustainable to have 6, 7, 7.5, something in that neighborhood. And we think that's where they're really going to settle in. And in any type of growth curve, you often see a period of very dramatic growth, and then some period of turbulence as new factors come in, and then the growth starts to pick up again, and that's what we would expect coming out of China in the next few years.
Let me ask you something. It's sort of an economics question, but we hear this issue of China wanting to move over into a consumption economy. And you'd think that's something Americans can teach them because we're particularly good at being a consumption economy. But if you're not a consumption economy just yet, and you are governed by centralized spending, at least they seem to be doing the right centralized spending in building this infrastructure so that it becomes attractive for for private investment and for people to conduct business.
That's absolutely right. I mean, if you think, if you rewind 5 or 6 years, everyone always spoke of China and India in tandem back then. And I think, fast forward to 2013, what most people will say is China's been able to succeed because of the government, and everyone thinks India will eventually succeed in spite of the government.
Right.
So, they've really had a model that's worked, but there is a new phase that they will need to enter, and that's what I think everyone is, including ourselves, is looking at and trying to understand when that transition is going to happen and how is it going to happen.
John, let's just, how do you make that transition? I mean, in our way of thinking of things, you put stuff on the shelves at attractive prices and you create a consumption economy. What is it that has to happen to make China into a consumption economy? Do you have to re-educate people to buy things? And frankly, is there some danger that we push things too far and get into a situation like we got into in the United States where people borrow beyond their means and then are of no use to the state in keeping things going?
Okay, 2 answers to that. One is, don't be too concerned with them having too much credit card debt, because that credit card and the availability of consumer debt is very slow in coming. But let me give you an example of how they're distributing, how they're getting the consumer outlets in place. China had, like the U.S. Postal Service has lost $8 billion last year. It was either $8 billion or $18 billion, one or the other. It's irrelevant. China has, of course, a network of postal offices in every little nook and cranny of the country. They are taking those post offices and they're converting them into retail stores. And so if I'm a farmer in the boondocks of Xi'an or wherever, I can use that as my outlet, not only to go in and shop, but I can also go in there and order things over the internet, and I can order fertilizer or seeds or anything else. So a combination of the infrastructure development to these, second and tertiary cities, plus making consumer products available right at their doorstep, is going to transform China accelerate China in a consumer economy. At the top, of course, China is a very aspirational society. 300 million people have gone from the rural, non-part of the money economy into the money economy. That's a huge amount of buying power. And so very smart about getting the goods out there that they can buy.
But ultimately, the most important thing if you are creating a consumer economy is to make sure your consumers have as much disposable income as they can get.
Absolutely, and if you look at it, this is one of the reasons why a lot of the textile manufacturers are moving to Vietnam or Cambodia or Honduras, is because the wage scales in China have been rising dramatically, very dramatically. And therefore, there's a growing lower and middle class that can consume a lot of goods.
If you dropped in from Mars and you looked at China's economic growth over the last several years, and you were to explain basic investments to a Martian, they would say, well, that must have been a remarkably good investment over the last 10 years. But for equity investors, China has not been a great investment. So how does that change going forward?
I think, as John mentioned, as they go to a more open and transparent market, that will be a big difference maker. So you're absolutely right. To be able to capitalize on the growth has proven difficult. Even in our own portfolio, we've got a very large amount of exposure to China. We've had to do it almost exclusively indirectly. And what I mean by indirectly is we primarily go into China through our actual portfolio companies to establish either greenfield, brownfield, add-on acquisitions in order to capture that growth and be able to bring it and get the equity value for it. We have found it much more difficult to invest direct dollars into China from the fund itself versus through our portfolio companies.
So if these folks in here decide they like this conversation so much they want to go home and get onto their E-Trade account and buy China stuff, do you think that the time is right for that, or is this still not there?
Yes,
Really?
yes.
Interesting, okay.
We're buying heavily in China. Here's the reason why.
I
was-
imagine the things you can buy are different than the things I can buy.
No, you can buy them just as I can buy them. But here's the thing. I was very lucky. I got to know John Templeton long before he died. And I was sitting there one time, and I asked him two questions. I said, John, you invested in these Japanese companies way ahead of the rest of the pack, and why and how? He said, I was looking around the world, and I saw all these Japanese companies that were selling for 1x earnings, and they were quality management, and they were growing. I said, John, how many companies did you find that were selling at 1x earnings? He said, you would be surprised. Then he started buying. He did his homework, by the way. This man was very smart. And he did his homework. He started buying. And, of course, a self-fulfilling prophecy. Everybody else thought John Templeton was very smart. So they started buying Japanese companies. And, of course, his stock portfolio went up, and then he started going to all kinds of emerging markets. So the reason we're buying Chinese companies right now is there are a lot of Chinese companies, even some listed here in the U.S., particularly ones listed here in the U.S., that are good companies, but they were tarnished by the bad companies. And I think it's been a little bit of overkill. And so if you do your homework, if you pick and choose very carefully, there are a number of Chinese companies selling at very, very, very low multiples, 1, 2, 3x earnings, growing at 20, 30, 40, 50% a year, beginning to go internationally, and they're quickly climbing the credibility scale. They're beginning to have international reporting standards. They're beginning to realize the value of openness and good financial statements, transparency. However, there's still a problem. And that problem is that within China, there's still a hesitancy to allow, even with the major accounting firms like, say, Deloitte and Touche, they might have a US-listed Chinese company. Deloitte would audit the books here. Their Chinese subsidiary would audit the books there, but the government in China will not yet let the auditors go into the books of the Chinese company. They'll get over that very quickly. They're climbing up the learning curve very, very quickly, but now's the time to get in.
Stephen, to this point of international reporting standards, one of the difficulties people like me have, and I don't know whether you do, and you tell me, is in getting accurate reporting from China. We often have to use sort of triangulation to figure out whether the reporting standards, what they're saying is happening, is actually happening. And you know that you both will be familiar with those companies that gather intelligence in interesting ways, satellites that sort of see how many lights are on, how many factories are running, to see whether their numbers are actually correct. Can you trust Chinese information?
Well, I think if you look at our style of investing, there are really two differentiated factors here. One, because we're a private equity fund, we do operate on private information exclusively. So when we go into places like China, we spend a lot of time, resource, and care doing a quality of earnings and making sure that we do a very thorough forensics accounting exercise. And certainly, when you have a global mandate, that's absolutely crucial. Even basic differences between an IFRS and U.S. GAAP can be material. So when you get into more exotic places,
We're talking about accounting standards.
Accounting
public
standards,
accounting standards.
correct.
Yeah.
Secondly, again, that's one of another reasons why we tend to go in through our portfolio companies so that we can put in the financial staff that's going to operate the business after we own it, and therefore have control of the business and make sure that the financial reporting coming back to us is, are numbers that we can rely on.
Do you think I can trust information coming out of China?
I think it's very hard to paint sort of a homogeneous brush across a single country and really say the accounting standards or the financial reporting and transparency is good or bad. I think it's really a case-by-case basis.
I mean, Jack Welch doesn't trust the reporting standards coming out of the United States. Do you generally think they're getting better, worse, or that there isn't really a problem with...
In the U.S. or China?
In China. Or in the U.S., for that matter, since we're talking. We're going to cover the world, so we might as well...
I completely agree with Stephen. You really have to do your own individual homework. You have to do your own forensic accounting. For example, I'm invested in a number of Chinese companies. And one of them, we were kind of curious about the bank statements, in fact. And so we sent one of our accountants into the local bank branch, and the bank branch manager, confirmed the statements. Well, the bank manager was actually on the payroll, and he was giving of the company and was giving out false information. So believe me, it's very tough to dig below the surface. It would be something you would never even conceive of in this country. Mm-hmm. If the bank said, yes, they've got so much money in the bank, you just take that. But sometimes it's like when we look at companies, I love to buy companies, sell companies, and what I do is when we go in an analysis of buying a company, I don't want to talk to the CEO or the CFO or the treasurer. I want to talk to the person who puts the numbers into the books, because usually they're very naive and they'll tell you everything you want to know. And it's so easy to do, because you just get out a balance sheet with all the footnotes, and you want to read all the footnotes first, and you just go down every list and you say, okay, what is this? You say cash, or you say receivables, you say inventory. You give me a little bit of information about that. That's the only way you really have to dig deep. In the West here, we have a real problem, and that's a lack of time. So therefore, if J.P. Morgan or Morgan Stanley or Wilbur Ross says something is good, you just say, well, we don't have to do our homework. We automatically say, that's good, sign me up, here's my money. Every once in a while that backfires, because everybody is so busy that sometimes you make a mistake and you just can't always follow the leader.
Let's move on to Europe for a moment. Give me your sense of where we are. We on a week-to-week basis get some conflicting information out of Europe as to whether or not they've largely hit bottom and are getting better, or whether they're in a sustained period of stagnation.
Well, we think they've done a lot to date, and Europe has been the focus of ours for now the last few years. And if you look at some of the reforms that they've put in place, we think they're very helpful. And you really need to go somewhat country by country, but our general mandate for our fund is really turnaround and distress type investing. So, the geography that first comes to mind today would be Europe and Western Europe specifically. We've got a big investment in Ireland. We think they were the first of the peripheral countries that really made the difficult decisions up front, and they're benefiting from it today. If you look at some of the more difficult places, like a Spain, like an Italy, like a Greece, we think they've done a lot. You have to kind of pare back the headlines, and most people get stuck on, a place like Spain, they get stuck on 27% unemployment. Well, it must be chaos, right? When we get to 8% unemployment, it feels like we're in an absolute depression.
Right.
So at 27%, what on earth could be going on over there? But you get there, and you do get the sense that they underneath the headlines, they have put in quite a bit of reforms, both socially, in terms of the labor structure, which we're starting to see some green shoots come out of. Now, are they out of the woods? Not yet, but we are seeing the benefits of some of the decisions that they've made over the last 2 years. At the same time, clearly the banking system there needs to be fixed. Clearly they need to figure out how to really, how they will continue to exist with, a common currency, but, individual, an individual country, banking system behind it. And that's sort of a very, very big principle that they've yet to sort out. So we think Europe sort of is generally on the right track. We think it's going to continue to take some period of time to see the improvements, but we're spending, I'd say that's the region we spend most of our time these days, and we think we are at right now, depending on the country, at the beginning parts of when one ought to start putting investment dollars on the ground.
Your comment about perspective is interesting, John. I was speaking to an Italian economist the other day who said, you think we're moving very slowly and doing very badly. 75 years ago, we were shooting at each other. So we actually think we've made some remarkable strides. What's your sense of Europe?
I agree with Stephen, and for a couple of reasons. One is, it's human perception of how things are going that's often more important than the reality. And when they decided to continue funding the thing, there's a formula that works. If the cost of long-term funds is below the GDP growth rate, then you can grow your way out of a liquidity crisis, which is what has happened in Europe. And as long as Europe stays the course in this route, it will gradually get better and better and better. But I love opportunities. I love bottom fishing. And one of the best things that I've seen in Europe and in Greece, that was a basket case, is what the Chinese did there. The Chinese bought half of the port of Athens. And it's like, they had the good bank and the bad bank and everything else. Well, now it's the good port and the bad port. The Chinese-run port is gleaming. It's efficient, even though there are Greek workers there. The other side of the port is just falling apart, and people are yelling, and there's trash in the water, everything else. It's amazing. So if you go into these economies as a private equity investor, hedge fund investor, where you can put your own people in on the ground, there are huge opportunities. It's definitely on the way up, not on the way down. But what you're really doing is you're buying enough time to create a unified fiscal organization, not just a monetary organization. And that's the ultimate goal, to create like the United States, a federation of European states where there's a common political as well as common economic base.
You brought up China investing in Greece, and you brought up sort of growth, and that brings me to Africa. This is a summit that has always had a remarkable interest in Africa, and we often speak to African leaders and get their own stories in their own terms. Recently, not recently, but China's been involved in Africa for some time now, and there are real questions as to whether that's good or bad. Some Africans are getting frustrated by what's going on, but they're also getting roads and buildings and highways that haven't been built in 50 years. And now Brazil has just forgiven $1 billion worth of African debt, obviously with an eye to playing a bigger role in Africa and getting a piece of that business. What's your sense of Africa and how we should be looking at it?
We historically have not been very involved in Africa. We find that we think it has great growth potential. We do think sort of the fundamentals are there for growth rates to be strong. But it's not a geography where we have, I'd say, the expertise to really navigate. We've just recently dipped our toe in, again, indirectly through a portfolio company into South Africa. They've got a growing automotive business. We've got a big auto supply business. So we've just set up our first plant that services the big BMW manufacturing facility in
Right.
South Africa. So for us, it is a bit of a new frontier that we're just starting to break into and just starting to analyze how we can play it.
But as a portfolio point of entry, South Africa is not a bad one because it plays such a big part in commerce through the rest of Africa. You have any involvement in Africa?
Absolutely. Well, in fact, I have a personal involvement. My son, who's procrastinating, he just got out of Harvard Law School. He's going to work with Clary Gottlieb, but he said, hey, wait a minute, life's too short. I'm going to Africa. So I thought I had a picture, and 3 days ago, he was on a camel in front of the pyramids in Cairo. Then he went to Johannesburg in South Africa, and now he and a buddy have a truck that they've rented in Namibia, and they're driving on this truck with a tent on the roof all through Namibia and Botswana to Zaire and Zambia and Victoria Falls before coming and sacrificing his life for the law. So I have a personal interest in Africa at this moment. But from an investment standpoint, there are many straws in the wind. And if people keep saying something like 5 or 6 of the top growing countries in the world GDP growth are in Africa, well, that's a little misleading.
Because they're from a low base.
From a very low base, but here's how we go into Africa. The one thing that's missing, or two things that are missing in investing in Africa, one is capacity. Unless, from a private equity investment basis, unless you've got an internationally trained local person, you're in trouble. You just don't know about the lay of the land. But the other thing is information and history. The U.S. doesn't have a lot of history in Africa. The Europeans do. But you know who we're using in places like Angola? Our friends from Russia. And we know a lot of people in the Russian financial community, and particularly the Russian shipping community, that spent decades moving, sugar from Cuba to Angola and minerals from Angola to Cuba to Russia. And these are the people who we know well, who we trust, who are Russians, and they're helping us get into places like Angola. But if you listen to somebody like Jim Rogers, we were at Yale together, he is very, very bullish on place even like the Congo. Angola,
Interesting.
Congo.
Like a lot of stuff in the ground.
A lot of
in the
stuff,
Congo.
but how do you get it out without getting your hands chopped off?
Right. We have a couple more minutes. Let's bring it back home for a second here. Given the choices, because clearly you have expertise and choices and capital that can be deployed anywhere in the world, what does America look like by comparison?
Well, for our investing style, we think America, we still think there's opportunity here. I'd say overall, we think asset values are pretty inflated. Clearly, we've got sort of the Fed actions that have really created, we think a little bit of an overheating of the market. So the way we're looking at the U.S. today is really, in a rifle shot opportunity type market, and that broadly speaking, we don't think the U.S. is that interesting, particularly when you look at the values that you could find, in Europe today. But in specific sectors, we do find very compelling opportunities. For example, energy. If you look at the natural gas sector, at $3.75, you don't make any money pulling gas out of the ground. It's just, the simple arithmetic of it. So we think there's some pretty good asset values there. We're looking at specific segments within the building materials spectrum, particularly on the heavy side, the construction side. There's still overcapacity. There's still too much fragmentation, and we think there's some value there for players like ourselves. The banking sector, which has gone through a very extensive overhaul, still has a very high number of troubled institutions, and those will need to be cleaned up. So those are some of the specific areas that we're focused on, but broadly speaking, we think asset values are far too high, and we think, particularly on the fixed income side, we just would be very cautious going out with any type of tenor in a fixed income instrument today.
And your sense of America, John?
Well, I love America. I love being here. But however, my passion is really the peaceful transition from the nation state to the global state. So therefore, and I also am passionate about how business may be the biggest and best door opener ever, because it doesn't matter who you are, where you're from, what race, religion, country. If you want to do business, then you can get it done. So it's a great common denominator. So what we've created, we looked at the world, and particularly in light of what the subject of this discussion is, global investing, we looked around and we said, does anybody actually have a vehicle to cater to people who want to be invested globally? And our answer was surprisingly no, not an appropriate one. We said, well, there's Warren Buffett with Berkshire Hathaway, and he's got an incredible track record, and it's over 20% compound over a period of time, and a terrific company, public company, all that, everything. But Warren Buffett has a couple of deficiencies. One is they're primarily domestically oriented, and two, they never paid a dividend. Then we looked around for other role models. We said, Harvard Management, great role model. And Harvard Management has a totally diverse portfolio of investments, hedge funds, public companies, forestry all around the world, 12, 13% of their assets in forests, everything else. And their management team is, you can't even identify what country they're from. Brilliant people, one and all, and they draw upon the expertise of the university to ratify their investment decisions. But it's a private university endowment fund. I can't invest in that. I may be able to benefit from it, but I can't invest in it. So what we did is we said, well, don't talk about it, just do it. So we've set up something called Global Investors Limited, Bermuda-based, designed to be a very large cap, highly liquid, publicly traded instrument that will invest in probably half its assets in portfolio securities everywhere in the world, and the other half in private equity, all the way down to not only venture capital, but starting companies. I have a company called Spring Investment, another one called Turtle Snap, and Turtle Snap is a growing global network of companies that only start companies, mostly driven by women. We provide $1 million line of credit to really think through a company, ready, aim, fire. That goes into the ready phase so that the entrepreneurs, we're very carefully about choosing entrepreneurs. We use Ashoka and Bill Drayton's model on that. But what it does is enable the entrepreneurs to really think through where they're going before they go into the ready, aim, fire. And it's got to be fast. So we created this vehicle so that I or a hedge fund or a sovereign wealth fund or pension fund can really invest in a global array of investment opportunities in the U.S., in Africa, in China, in Europe, anywhere in the world, but in every kind of investment vehicle. And if you look at Warren Buffett, he has 23 people who really run the company. And we feel we don't need many more than that to really build this out. And the key thing, of course, is finding and employing the very best talent you can get. Not indirectly through a hedge fund, although I wish I had money with Wilbur Ross, but directly. You hire the Stevens of the world and you say, hey, and here's another thing. By doing this, what you're doing is you're empowering people. You're empowering people. I was an assistant to a guy named George Cabot Lodge at Harvard Business School, and George and I went all over South America. We set up something called Incae Business School in Central America. Spent a lot of time out in the jungles, had a lot of fun. But George wrote a book on vehicles of change. And he said the business corporation is the most effective vehicle of economic, social, and political change ever invented. As long as you cater to you have a balance of the 4 constituencies that are important. The first is your customers. You've got to listen to your customers, find out what they want, and then provide it. The second thing is your employees. Unless you empower your employees and treat them with respect and encouragement, you're out of business. The third is your shareholders, the people who gave you the fuel for that engine of change that enabled it to happen. You have to treat them more than fairly. But the fourth is often forgotten. It's society. Unless you're a good corporate citizen, you pay your taxes, you have full disclosure, but you encourage your employees, and at the corporate level, you're explicit about the role that you have to play to better the society in which you live, you're not going to do very well. And tests have shown that. Companies that have an explicit social policy trade at something like 5% higher market cap than they don't. So this vehicle that we're creating not only has an economic interest in taking advantage of every place in the world, but also it has to respond to all of those 4 constituencies. So we're having fun.
Gentlemen, thank you both. For all of you out there, I don't know how much you paid to be here, but if they were charging fees, that'd be worth about $1 million, what you just got today. You got some real insider views on things. So thank you both very much for sharing your expertise so willingly with us.